it seems hard to believe, but there are dozens of Sydney suburbs where property prices have fallen in the past year.
New research has discovered a number of Sydney suburbs where people don't want to buy, even though sellers are willing to drop prices.
You've got investors more active in the market than first home buyers just because of affordability constraints.
New CoreLogic data just revealed that nearly 30% of Australian suburbs are experiencing price declines right now. In Ballarat, 100% of suburbs saw prices fall in the last quarter. In Geelong, 97.8% of suburbs are dropping. But here's the stat that should shock every property owner. In Melbourne's Chadstone, unit prices crashed 33.3% to just $505,000. Crow's Nest in Sydney, down 20.7% to $900,000. And according to property experts, these declines are just the beginning. By the end of this video, I'll reveal the exact 10 suburbs where prices are dropping right now and the warning signs that could predict your suburb is next. Here's what's changed in Australia's property market. For the past 2 years, we've heard nothing but property boom, record prices, and buyer frenzy. And nationally, that's still technically true. Dwelling values closed 2025 at around 8% higher according to CoreLogic's latest data. But here's what the headline numbers don't tell you. While Perth saw all 302 suburbs record price, increases with 0 suburbs declining. Melbourne and regional Victoria are experiencing the opposite, a mass price correction affecting hundreds of suburbs simultaneously. CoreLogic's head of research, Eliza Owen, explained that while supply remains tight nationally, the demand environment is shifting. Inflation forecasts have been revised higher, interest rate expectations have adjusted, and households are facing stricter borrowing assessments. Translation, even with low supply, prices are still falling in specific areas. And it's not just cheap outer suburbs. Some of Australia's most affluent areas are getting hammered. Before I reveal the top 10 suburbs at risk, let me show you the 3 factors that determine if your suburb is about to drop. Here's how to predict if your suburb is next. According to property analysts, 3 key indicators predict price declines with scary accuracy. Warning sign number 1, oversupply of new apartments. When developers flood an area with high-density apartment buildings, supply overwhelms demand. Melbourne's Southbank, Docklands, and Sydney's Zetland are textbook examples. CoreLogic data shows Melbourne's total property listings are 25% higher than the 5-year average, creating intense competition that pushes prices down. Suburbs with a high supply of new apartments like Brisbane's Chermside and Fortitude Valley are next on the watch list. When there are too many properties chasing too few buyers, prices have nowhere to go but down. Warning. Sign number 2, high interest rates stretched affordability. With the RBA holding the cash rate at 4.35%, a 13-year high, mortgage repayments have become crushing for many buyers. This is especially brutal in expensive markets like Sydney, where the median house price hit $1,645,444. When buyers are priced out, demand evaporates, and when demand drops, so do prices. Simple economics. Warning. Sign number 3, economic dependence on single industries. Regional areas that rely heavily on mining, tourism, or manufacturing are extremely vulnerable. When those industries slow down, employment drops, consumer confidence craters, and property demand collapses. Now that you know the warning signs, let me show you the exact suburbs where all 3 factors are converging right now. Let's start with regional Victoria, where the damage is catastrophic. Number 10. Warwick Nabil house prices fell 19.6% to a median of just $198,000. This regional town's economic base has weakened significantly, driving down property demand and values. When your median house price drops below $200,000, that's not a correction, that's a collapse. Number 9. Barwon Head's house prices dropped 20.5% in the past year. This coastal town near Geelong, once considered a desirable lifestyle location, has been hammered by the combination of high interest rates and buyers fleeing Victoria entirely for Queensland. But here's what should terrify Victorian property owners. In Ballarat, 100% of suburbs recorded price falls. In Geelong, 97.8% of suburbs saw declines. This isn't isolated weakness. This is systemic collapse across entire regions. Number 8. Mornington Peninsula. Crib Point prices dropped 7% in the last quarter according to CoreLogic data. The Mornington Peninsula, long considered Melbourne's premium coastal escape, is now experiencing sharp corrections as buyers balk at high prices combined with rising interest rates. Property analyst CoreLogic found that affluent suburbs like Box Hill and Canterbury are particularly affected by the combination of high property taxes in Victoria and stretched affordability. Even wealthy areas aren't immune, but regional Victoria isn't the only place getting destroyed. Let's look at Melbourne's metro areas. Melbourne's apartment oversupply is creating a price bloodbath. Number 7. Sunshine, Melbourne unit prices declined 18.9% to $450,000. This outer western suburb has been flooded with new apartment developments that simply can't find buyers. High vacancy rates and intense competition between sellers are driving prices down relentlessly. Number 6. Docklands, Melbourne. High vacancy rates in Docklands are putting downward pressure on property values, according to property market analysts. This once booming high-rise precinct has become synonymous with oversupply. Thousands of apartments sit empty while prices continue falling. Here's the cruel irony. Melbourne desperately needs more rental properties after 21,700 were removed from the market due to Victoria's tax changes. Yet in Docklands and Southbank, apartments sit vacant because investors won't buy them at current prices, and they definitely won't buy at future lower prices. Number 5. Chadstone, Melbourne. Unit prices crashed 33.3% to just $505,000. This is one of the steepest declines recorded in any Australian capital city suburb. Chadstone, home to Australia's largest shopping centre and once considered a prime location, has seen unit values absolutely demolished. A 33% price drop means if you bought a unit for $750,000 2 years ago, it's now worth $500,000. You're in negative equity. You can't refinance. You can't sell without massive loss. You're trapped. But Melbourne isn't the only capital city experiencing pain. Sydney, Australia's most expensive market, is showing cracks too. Even in Sydney, the oversupply problem is crushing prices. Number 4. Homebush, Sydney. Oversupply of apartments is driving prices down according to recent property reports. This inner west suburb, once popular with investors due to its proximity to Sydney Olympic Park, has been flooded with high-density developments. Too many apartments, not enough buyers. Number 3. Zetland, Sydney. Another Sydney suburb plagued by apartment oversupply. Zetland's transformation from industrial area to high-rise residential precinct happened too fast. Developers built faster than the market could absorb, creating a glut that's now hammering prices. But here's the suburb that should shock every Sydney investor. Number 2. Crow's Nest. Sydney unit prices fell 20.7% to $900,000 according to recent property reports. This North Shore suburb, traditionally one of Sydney's most desirable locations with excellent transport links and village atmosphere, has been crushed by apartment oversupply. When even premium North Shore suburbs like Crow's Nest see 20% plus declines, that tells you the oversupply problem in Sydney is far more serious than the media reports. These aren't fringe locations. These are established, desirable suburbs getting destroyed. But there's one suburb experiencing a decline that symbolizes everything wrong with Australia's property market right now. The number 1 suburb at risk reveals the real crisis. Number 1. Southbank, Melbourne, Parramatta, Sydney. These two suburbs represent the same problem in different cities. Massive oversupply of investor-grade apartments combined with fundamentally weak demand. Southbank in Melbourne. High vacancy rates putting downward pressure on property values. Thousands of apartments built during the property boom now sit partially empty. The rental vacancy rate in these high-rise precincts remains elevated even as Melbourne's overall market tightens. Parramatta in Sydney. Similar story. Oversupply of apartments in a suburb that was marketed as Sydney's second CBD. Developers built aggressively. Investors bought off the plan. And now both are discovering there simply aren't enough tenants or owner-occupiers to absorb the supply. Property analyst analysis makes it clear suburbs with a high supply of new apartments, such as Chermside and Fortitude Valley in Brisbane, may see price declines due to oversupply of units. The pattern is identical across all capital cities. Developers overbuilt. Government stimulus encouraged buying. Fixed price contracts locked in. And now the market is correcting violently. So where do prices go from here? According to CoreLogic's Eliza Owen, supply remains tight, but the demand environment is shifting. Inflation forecasts have been revised higher, interest rate expectations have adjusted, and households are facing stricter borrowing assessments. Translation: even with limited supply, these factors can temper buyer activity even when stock levels are low. Here's what property experts predict for 2025 to 2026. Continued declines in oversupplied areas. Melbourne's apartment precincts, Sydney's Zetland, Homebush, Parramatta corridor, and Brisbane's high-rise suburbs will continue experiencing price pressure as supply overwhelms demand. Regional Victoria remains weak, with 100% of Ballarat suburbs and 97.8% of Geelong suburbs recording falls. The regional Victorian correction has further to run. Property taxes and investor exodus continue driving prices down. Two-speed market intensifies. Perth recorded 0 suburbs with price declines. All 302 suburbs rose. Meanwhile, Melbourne and regional Victoria experience mass corrections. This divergence will widen in 2025. Interest rate impact. If the RBA cuts rates in 2025 as expected, it could provide relief to some markets. But heavily oversupplied areas won't recover quickly. There's simply too much stock to absorb. Property forecasters including KPMG, CoreLogic and CBA expect modest national growth of 2 to 6% in 2025. But that national average masks the reality. Some suburbs will rise 10% plus, while others fall another 10 to 20%. So how do you protect yourself from price drops? If you own property in one of these at-risk suburbs, here's what experts recommend. Don't panic, sell. If you don't need to sell, holding through the downturn is often better than crystallizing losses. Property markets are cyclical. They recover eventually. Check your equity position. If you're in negative equity, owing more than the property is worth, contact your lender before you face financial stress. They may offer hardship provisions. Monitor local supply. Keep tracking new development applications in your area. If more high-density apartments are approved, that's a warning sign prices could fall further. Consider your timeline. If you're a long-term investor, 10 plus years, short-term corrections matter less. But if you plan to sell within 2 to 3 years, these declines could seriously impact your returns. For buyers, these declining suburbs represent potential opportunities, but only if you believe in long-term recovery. Don't try to catch a falling knife by buying in suburbs that are mid-correction. Wait for clear signs the decline has bottomed before entering. According to property research site RateSeeker, economists predict that interest rates may fall in 2025, which could lead to a recovery in areas where house prices have dropped, such as Melbourne suburbs and regional areas like Geelong and Ballarat. But that recovery is not guaranteed. Some oversupplied suburbs may take 5 to 7 years to work through their excess stock. Others might never fully recover if demographic shifts permanently reduce demand. Nearly 30% of Australian suburbs are experiencing price declines right now. In Ballarat, 100% of suburbs saw falls. In Geelong, 97.8% of suburbs dropped. Melbourne's Chadstone crashed 33.3%. Sydney's Crow's Nest fell 20.7%. The cause? A toxic combination. Oversupply of apartments in high-density precincts. Interest rates at 13-year highs, crushing affordability. Stricter borrowing assessments reducing buyer capacity. Regional economic weakness in Victoria specifically. While Perth recorded 0 suburbs with declines, all 302 rose, Melbourne and regional Victoria face systemic collapse. CoreLogic data shows Melbourne's listings are 25% above the 5-year average, creating intense downward pressure on prices. Property experts warn that suburbs with high apartment supply like Brisbane's Chermside and Fortitude Valley are next. The oversupply crisis that destroyed Southbank and Docklands in Melbourne and Zetland and Parramatta in Sydney is spreading. If you own in one of these at-risk suburbs, monitor your equity position carefully. If you're buying, understand you might be catching a falling knife. And if you're watching from the sidelines, realize that 30% of suburbs declining means this is no longer a fringe problem. It's mainstream. Subscribe so you don't miss the next video where I'll reveal the opposite list, the top 10 suburbs about to surge in price and why smart investors are moving their money there right now. The question isn't whether more suburbs will decline. The question is your suburb next? Thanks for watching.